pick this up again here. This is just kind of a continuation of the option spreads. Before I went through the covered calls, probably a little too much there, and then the buyers and sellers and what they do. So now I'm going to kind of look at a vertical spread, which is probably one of the easiest ones to try to understand. And this is not using shares of stock. This is just going to use two different option legs, two contracts, and we're going to show you what that does. So if we look at Tesla here, we're just going to use this one as an example. This is not a trade idea, just like the Meta one wasn't before. I'm just using something to give you a hypothetical here. So if you're looking at Tesla and you say, you know what, I like Tesla. I want it to go, let's say you want it to go over this 369 area. And you think it's going to do that next week. You think next week is actually going to close over this supply zone here. And you feel pretty good about that. So what you could do is build a trade around that. And you notice how when I'm saying this, I'm saying first plan out your trade. You are under the impression that Tesla is going to close over this. This is your target. You have a target. Now you're going to plan a trade around it. Well, yes, you could just buy out of the money calls, in the money calls, whatever, with time, short dated, however you want to play it. You could just do that. We're going to go through a spread instead. And we're going to look at, we're looking at Tesla. Let's look at next week. Let's say, you know what, I think it's going to happen next week. So we have, what did I say, 368? Okay, so you've got some premium in here still. But let's say, you know what, you just kind of want to be a little bit safer. You wanted to buy closer to the money. You want to buy a 330 and oh, but it's $14. Well, that's kind of expensive. That's not something I really want to buy. Okay, well, if you look at just the single call 1460, let's look at the risk profile here. The risk graph. Okay, now remember a standard share of stock is just a nice diagonal. Well, the risk graph here, now there's a bottom. And what's the bottom? Well, it's zero. It's what you paid for. It's $14.60. That is what you're risking. That is where your bottom is. So you can control 100 shares of Tesla for $14 instead of $330. Okay, or whatever it's at right now, I guess. So that's what this risk graph shows here. Now you're saying, you know what, $14, that's just it's kind of expensive, not exactly what I wanted to risk, and that is fair. So let's go back here. Let's say, okay, I'm buying the 330, but I think it's going to close over 368. But this is a little far out of the money here. Let's look at potentially the 350. Okay, so the 350, and that's a 20-point spread. I'm just going to control, add that in. So you see how here now it's a vertical. That was just a keystroke that I did there. You can also go right click, analyze buy trade, and go vertical. It automatically just kind of does the next strike, and you just change this to 350. So either way, they're both the same thing. Now you can see here, your spread is now $7.83. So you've effectively, almost cut that in half. Okay, well, that's good. What have you done here, though? Okay, well, you still have a bottom here. By default, option contracts are a hedge, but now it's $7.83 instead of, the 14. But if you look here, now you also have a cap up here, just like you saw in the covered call. Okay, well, what a vertical spread does is it limits your downside and it limits your upside. But what you get from it, and let me actually add just a single call here. And we'll take that off. What you get from it here is going to be a couple of things. Look at the theta here on a 330 for next week. You know, it's only 9 days to expiry. You've got 96 cents. That's pretty heavy. So if you're doing a if you're buying this, your theta is essentially it's looking to lose 96 cents every day, but actually it's going to ramp up. It's really going to pick up because you're inside the single digit range. So that theta might be $1.05 tomorrow, or I don't know, 97, 90, 98 cents, something like that. I'm not too versed on understanding what that's going to be at, but you get the point. Well, when you're doing this and you're buying a 330, you are positive, or I'm sorry, you are negative theta here. No, yeah, you're buying 96 cents in theta, but then you're selling the 350 and it's 77 cents. Okay, so what you've done is you've just taken your theta from 96 cents to now basically 20. Okay, because you are collecting this 70 cents. This 77 cents is working on your side. Okay, and that is what is happening here with this spread. So now your theta, let's see if this actually shows this. Okay, yeah, so right here at 326.46, your theta on the single contract, it's looking at negative 94.5. And if I switch it to the spread, you're looking at 17 cents. So theta is now, I wouldn't say it's necessarily on your side at this point. And that's really only because we did go pretty far out of the money, and we are in this single digit time. But you have negated theta quite a bit. Now, you can look here. Let's say 330 is good, but what about 335? So this is only a 5-point spread. Now look at your theta. $2.90. That doesn't make sense. I think actually theta would be, let's see here. Oh, I'm looking at it. Let's see. 96. I got things moving around here too. And 93. So really you're looking at like a 3-cent deal. I'm not sure why this is showing that way, but in this case you're looking at 3 cents theta. Like theta is not really an issue for you at that point. Just because you are I believe it's actually positive delta theta on the 335s and negative on the 330s. So you're collecting this 93 cents, getting rid of the 96. So anyway, that's one of the advantages, is you're going to kind of negate theta, and people are comfortable with that, even though they are taking what is called an opportunity risk by capsizing their profits by putting a cap on it here. So with this trade, with this 5-point spread here, it's going to cost $2.40. And if Tesla closes over 335 by next week, then, you know, and honestly, if Tesla is trading over 335 next week, this could be worth a potential $5 because it's a 5-point spread. Well, you paid $2.40 for it. How much are you going to profit? Well, look in the lower left corner, that kind of light bluish teal, $260 right there. That's your profit, $260 on expiry. This line here, so this is your expiry graph. This purple line here, this is your time graph. So if you look, this is actually showing July 5th, and you can go here and you can do some hypotheticals. You can say, you know what, I kind of want to be out by Thursday. and you look, okay, well, on Thursday, which I think is the 12th. All right, let's do that. The 12th. So on June 12th, and Tesla, and you think, you know what, Tesla's going to be at 368 on June 12th. Let's go 368. Okay, so right here, 368 on June 12th, if it is there, you are looking to actually collect, look at the purple 242, while the expiration one is $260. So you're looking to collect almost the full amount of profit if Tesla is that far. Now, to really collect the entire thing, if you wanted to do that, you are taking a risk by doing this, but you would hold through. You see here, this is the expiration date, 6/13, but it technically does not expire until the after hours session closes on Friday. So you are really exposing yourself from the time that the bell hits at 4 o'clock until what time does it close? Probably 8 p.m., I think, Eastern time. You are exposed for those 4 hours to Tesla potentially dropping below your short strike, thereby not getting the full profit or any profit potentially, depending on all kinds of variables here. So you're taking a risk, but if you look here, this is 13th. On the 14th, that purple line goes away because now you're just looking at expiry. So the closer you get to today, you see how this line, we're just going to go day by day, and you see how it kind of curves up. That's your time curve. That this pocket right here, this empty pocket is going to be waiting on time. However, you see here, if Tesla gets far enough away, even let's just say tomorrow, for some strange random occurrence, it decides to go to 420 tomorrow, and you're in this spread, you could potentially grab max profit, even though you still have 8 days to expiry. That's a possibility. But you can use this risk graph to kind of plan your trade and say, you know what, maybe it's not going to happen. Maybe I actually want to go one more week out. Okay, so you're going to go to the 20th, and now it's not going to show up because we have expired contracts, so you have to change the date. Okay, so now we're looking a little bit further out in time. And if you look today here, it's going to take a little bit more. So this line isn't going to move quite as fast until it really starts getting closer to that expiration date. And then each day it's really clicking, right? So this is called a debit spread. This is when it costs you money. It costs you $2.40, and you're getting in a debit spread, and you are essentially, you're hoping that actually the stock goes above the short strike. And in that case, you are exposed to being obligated to sell your shares of Tesla at $335. Oh, but you don't have shares. Well, that's where the spread comes in and saves you. So if you do get, if your contract does get executed and you are obligated to sell shares of Tesla at $335, well, you have a contract that has the right to buy shares at $330. So if you were to buy Tesla at $330 and sell it immediately for $335, what would you profit? $5 minus whatever you paid, right? So if this actually does go in the money and you do get exercised, then you exercise your right to buy it at $330, and you're going to make $260. Look in the lower left. Okay, you're going to make $260 just as if it was just as if you sold it for max value at $5. Because if you sell it at max value for $5, you're going to make $5 minus whatever you paid for it. So hopefully that helped understand that a little bit. Now, this isn't necessarily a trade that I would take or really shun. I mean, it's really kind of not a bad trade if you think about it. If you look at this chart and you think, I mean, we're right here. You think Tesla is going to close over 335 by next week, but you're just not sure. You're not sure if, what's going to happen up here. You don't want to manage it. You don't want to worry about it, etc. Well, maybe you want to get into a spread here and you want to pay half. And essentially, what are you going to do? You're looking for 100% on this option, okay, on this spread. You buy it for 240 and you sell it for 5, that's 100%. You're making $260. It's over 100%. Is that bad? No. I mean, people love 100%. Now, you are exposed to the opportunity risk at this point. Let's go back here. As I was saying, so if Tesla does decide to go to the moon and go to 420, well, you're still just going to make $260. So you got to be okay with that. And that's just the way it works. That's just trading. So I don't always like to do these 5-point spreads, but sometimes I will like to do, let's go back and look at the 350, 330, 350. So this is a 20-point spread. How much is this going to be worth? $20. It's going to be worth $20. That's the max value of this. And if I spend $783, then I'm looking for what? Let's see. I'm looking for a 255% move. Off of my price. That's not bad. I mean, I'll take that. So, right, let's see, 783 plus 255%. Yeah. That's not bad. That's not bad. I think that's wrong. Let's look at, no, that's what it is. 1217. So let's do 1217 divided by 783. Let's do my math correct first. 155%. Sorry, my bad. So you buy this thing, it's a 20-point spread. You buy it for, almost $8, and you're looking to sell it for a total of 20, potentially, hopefully. That's going to be a max value of 155%, and you're going to have room to sell it long before that, right? This thing moves up, but it's starting to do some retracing. You don't like it. You don't like the setup anymore, whatever the case. And, you can sell it for 30%, 50%, whatever. But at the same time, you're only risking $783 instead of, whatever that was, 14 for the, 1460 for the 330. Okay. Or, the 350, if you were to buy the 350 instead, we'll look at that one. Okay. That one is cheaper, yes, than the spread here. But look at the risk graph here. Okay. And this is where, that opportunity risk comes into play. Because if you think it's really going to go, maybe a spread isn't the right bet. Because if Tesla is at 368 on expiry, you're looking to make $1,200. And which is actually, if you look at the spread, you're going to make $1,200 on the spread too. Wow, look at that. So it just depends on a lot of things. It depends on how fast things are moving, and the implied volatility and all this good stuff, as to which one's going to be a better option. But just to understand this, at least, is going to at least help, like I said earlier, help you understand the flow and what people do a lot. What a lot of the big investors, the institutions, they use spreads on the floor. In Wall Street, they use spreads, not all the time, but it is always a tool in their tool bag. You don't walk around with a tool bag without having a hammer. You're not going to always use the hammer, but you have it right there in case you have to use it. In case, the right tool for the right job. That's exactly what this is. It's just understanding the tools and putting the tools in your bag so that you have them, so that you have the correct tool for the right tool for the right job when they do come up, should you want to use those. But probably maybe should have streamed. I don't know if there's going to be any questions on this. Please feel free to ask. I think, what am I at, 20 minutes on this one now. Let's look at the flip side. So this is a debit spread. This is where you pay money. Now, I was talking about earlier on the last video is that sometimes people enter into the opposite, right? A bear call spread or a bull put spread. So let's look at a bear call spread right now. It's going to be the exact same thing. We'll do a 330, 350, except I will now sell to open the 330, and I'm going to buy to open the 350. Okay, so now I have flipped the script here. Now with a credit spread, it's much different. A credit spread means that you are looking, what is going on? I don't know what's going on. Oh, here we go. With the risk graph here, now it's going the other way, right? So now the further down it goes, the more profit you collect. And the further up it goes, obviously, the least or none. Same thing. Okay, you're going to have a max loss and you're going to have a max profit. However, with a credit spread, you are actually collecting this money right off the bat. So you open the trade, you collect $7.82, and that is going to be your max profit. That is the max money that you can make. You want this thing to expire zero or get as close to comfort as possible, and you can buy it back for, a lot cheaper. That is your goal. And for it to expire zero, it needs to remain under 330 or at least be under 330 by the time this expiry hits. The closer to expiration, the better it is for you because theta is actually on your side. Now you are collecting theta. You are grabbing that. That is your friend now. And with this one here, your max with the credit spread, your max loss is now going to be the other way. So if this is a 20-point spread, just think about this, and you are selling the 330s, well, if that gets executed and you are forced to actually, because you are obligated to fulfill that contract, and if you are chosen randomly to do so, if this does get in the money, you are saying, okay, I'm going to sell Tesla shares for $330. Oh, wait, I don't have any. Well, you could, well, not could, but well, you do have a contract here that says you have the right to purchase them at 350. So what does that do? Well, it's going to work in the reverse way. You buy them at 330, and let's just say Tesla is at 340 when this happens. Well, your 350s are out of the money, and you are going to exercise the right to buy them for 350. You can do that, or you can buy them at the market depending on how far in the money these are. So if Tesla decides to rip over 350, both of the strikes here, and you do get obligated, then you do want to go ahead and just execute that. So then you're going to immediately lose $20 because it's a 20-point spread, but you will collect the entire premium. So your max loss is going to be $20 minus $7.82, which ends up being $12.18. You can get away for, like I said, a little bit less, depending on how that whole interaction works. Like I said, if Tesla is at 335 or 340, let's call it 340, and somebody makes you obligate this contract here you are going to be short 100 shares of Tesla at 330, and but you don't have the shares, so you can literally just buy those at market value at 340 instead of 350 and save yourself 10 bucks, right? Does that make sense? Uh, but that's just a credit spread. Credit spreads are going to be a lot better when volatility is high. So when you get that VIX and it's ramped up, I'd say past 25 and beyond, that is when, you're going to see a lot more credit spreads hitting the tape. And just because the IV is juiced, it's pumped, and especially like right before earnings too, you're going to see those. Uh, but the other way, a bull put spread. So when you're doing a debit, it's a bull call because calls are bullish. It's going to be a bear put because puts are bearish because you're going to go in the direction. When you're doing credit spreads, they're going to be the opposite. You're looking at a bear call and a bull put. And so what that does, a bull put spread, is you're going to sell, let's say you want to sell the 325, and you want to buy the 315. We'll just do a 10-point spread here. Okay. So this is a 10-point spread. Again, you're going to collect money. So you're going to collect $3.55. That is your max profit. That is the max amount that you can win here. And your max loss is going to be 10 points. It's a 10-point spread minus your 355. So you're looking at 645 is your max loss, right? And with a bull put spread, you want Tesla to remain above your short strike. So however you spin it, you always want the stock to remain, or I'm sorry, your short strike to remain out of the money. Whether you're doing a credit spread, a bull call, or a bear call, or a bull put, doesn't matter. You want that short strike to remain out of the money. When you're doing a debit spread, ideally, in a best case scenario, you want that short strike in the money, in the best case scenario, if that makes sense there. Hopefully it does. But at any rate, these are just a couple of examples of vertical spreads. And the reason why people do these is to, like I said, is to kind of make that contract a little cheaper, and also give them a little bit of more comfort that they're going to be they have a little bit more. They still have delta. They don't have to worry about theta too much or as much. They don't know how fast or slow it's going to take for this to happen, but they're thinking it's going to happen before expiration or on expiration. And yeah, it just kind of gives them a little bit of peace of mind. It also it feels like they're not exposing themselves as much, right? You can buy 2 of these for the same price as one 330 basically, and reap the rewards there. Now, one thing I did forget is that time doesn't necessarily matter, in the sense that, let's just say hypothetically we get to June 13th and we have, let's go back to the easier one, the 333 for 35. We have this spread. Now, let's say Tesla has just not even touched 330 at all in the 9 days to expiry, and it's whatever, it maybe it plummeted, maybe it's just been trading sideways, whatever the case. You're going to be losing value, okay, whatever this is going to be worth. This thing could be worth 5 cents. All right. That's not ideal. I wouldn't recommend holding that, but who knows? Maybe you did. It could be worth 5 cents up until this day. And let's just say, hypothetically, Tesla decides, you know what? We're going to do it. We're going to blast through 330 and 335, and we are going to close today on June 13th. I want to close way above maybe 40. Maybe, really just 336 is really all we care about. Well, your contract, it doesn't matter how long it took, because your contract, should you choose to, or should you actually get exercised, or should you choose to, you can even exercise it yourself at that point. It's going to be worth a max value of $5. It doesn't matter as long as it gets there by expiration. And actually, some people even do that. You can literally do exactly that. If you get Tesla over $335 at any point in this trade, you can just go ahead and exercise yourself. Oh wait, no, you can't. No, you can't do it. I'm sorry. You will have to wait. Hopefully somebody exercises it and exercises their right to the contract and forces you to do the same, and then you can just clean it up, collect all the profit. But anyway, I kind of went another 30 minutes on those. Hopefully you guys got something out of that. I am sorry, like I said, there's so much more information available out there, and I highly recommend to looking into these if any of this actually piques any kind of interest. But let me know if you have any questions. Let me know if you have anything else you really want me to go over. I know I didn't touch on butterflies or iron condors, but those are quite a bit more advanced. So I just wanted to kind of stick with the more common ones here. But thanks, guys. Have a good night.